So I'm here with Pat McStay. He's the director at New Leaf Advisory. Pat actually reached out following a reel that I put up a few weeks ago regarding the changes to superannuation and the tax on unrealised gains. We had a great chat and just thought, look, it'd be a great way to unpack it, understand a little bit more, provide your clients, our clients, with a bit more feedback in terms of what this all looks like. Is it going to come into place? What are the changes? Who's going to get impacted? Is it going to cost more? All the rest of it. So I suppose the best place to start, Pat, is how do they assess the value of $3 million? I mean, we're doing a lot of letters for our clients. We're being asked to put valuations on paper or opinions on paper. We're now being told that they want 3 comparable sales, which has been a big change in our space. Is that what you're sort of seeing in terms of the literature that's coming out to you about these changes in the unrealised gain space?
Yeah, well, with the tax being levied on a movement in the valuation of self-managed funds. So let's just be distinct for a second. There's the industry funds, which we don't deal with, but there's self-managed funds, which we do deal with, and that's where they have privately controlled or directly controlled assets which require valuation. They're not listed securities on the stock exchange. It's properties and things like that which require valuation, and that will determine the foundation, the basis upon which the $3 million figure and the movement in value is assessed. So like I would expect someone like you to be in a difficult position or in a position of sensitivity and demand around valuation, because ultimately that dictates prospective Division 296 liabilities.
Yeah, and again, that's what we're finding as well. So the letters we did before, it was like, look, net income, approximate value was this, and now we're getting accountants come back or auditors coming back saying that letter's not good enough. So they're sort of going to another level, deeper and deeper. And I mean, again, they haven't really changed the narrative. There was sort of this big overarching comment that came out about potential tax on unrealised gains, and there's no real, I suppose, roadmap or confirmation of if it's going to happen or not. But I think the underlying part of what you're saying is we're now getting a bit more scrutinised as agents to prepare these letters for properties that are held in a fund, whether it's a SPV or whether it's part of a larger sort of larger thing. So the interesting part of what you and I discussed last time we caught up was more surrounding the implications of that tax. So you've got people who have, created an entity or an SPV, or they've created a vehicle to invest and purchase in property. They have made assessments based on return because it's obviously a lease investment. In most cases, some of them it's their own property, but in most cases it's a lease investment. The tax, we obviously know that there is some tax around it. I think it was 15% was sort of thrown around. And I've got a lot of clients who have come back to us saying, look, is it a situation where we need to sell the asset, put it into a company, sell the asset, pay the gain and just let it sit as cash and all the rest of it? But you made some really good points about, regardless of whatever happens going forward, if this comes into effect, that it is still the best way to hold your super or hold real estate holdings because of the tax that still sits within those funds. Can you talk a bit more about that?
Yeah, I think there's a few misconceptions just generally, which is just because of the ambiguous nature of the legislation and how it's kind of, it's not even into effect now. It's just been announced as coming into effect from 1 July without the granular details. So I think a lot of people are jumping to conclusion around how it works, the tax. And I think if you actually understand how it applies, particularly within a self-managed super fund environment, then you start to realise its impact, and you start to look at the opportunity costs and alternatives in investment and things like that. I think there's a few kind of key misunderstandings, I would say. One of the biggest one is you just talked about these knee-jerk reactions, like moving assets out of a self-managed fund into a company or into a trust or into a personal name. Like, our experience is the tax rates you face in a corporate environment or a personal marginal tax environment are higher than super fund environments.
Course,
so you're moving an asset that's generating income in a tax efficient environment at 15% in self-managed super, or discounted capital gains at 10%. It's a very low tax rate. That's before factoring in any tax-free pension. So, we're talking very, very low rates of tax in self-managed super. So to think of moving assets and income outside of that to pay higher levels of tax doesn't make too much sense. I think the other misconception is the application of Div 296 being prospective or in arrears. I think people think, well, I've bought assets worth $3 million. I've got unrealised gains of directionally, I don't know, 1 or 2 million, for example. I'm going to have to pay this big lump of tax. No, you're not. So it's prospective in nature. So you need to consider the impact of the movement in value from one year to the next, and it's on unrealised gains. So if you have, unrealised gains from the past are grandfathered in effect. I think, so when I think about the impact of the tax, I don't think you're paying more tax. I think it has an impact on cash flow of the funds. Because rather than deferring tax until you realise it and paying capital gains tax, you're paying tax on unrealised gains annually, at least, which changes the cash flow composition of when you're paying tax. So it's almost like pay-as-you-go tax for super funds. The only other thing that I think is a significant misconception is paying additional tax with Div 296. I think lots of self-funded retirees think capital gains tax and Div 296 are like additional taxes. Like, I'm going to be paying capital gains tax and I'm paying Div 296 tax, and that's not correct. So if you are paying tax on unrealised gains as you go, you don't also pay capital gains tax when you liquidate. So there's no additional taxation. It's just the nature of when they make you pay the tax on your gains. So I think it's been a little bit overblown, but I think it's also misunderstood. So there's a few, we've modelled this for a lot of our clients in terms of putting through their the cost base of their assets, the unrealised gains on their assets. What does it look like, on 30 June 2026, if your assets move up 10% or move down 10%? What's the Div 296 liability? What does it look like? And when we do that and we project that out, then there is a real tax cost in cash, and that's why I say the cash flow impact is real. But it's also mutually exclusive, because if you're paying Div 296, then your capital gains tax liability will reduce. So it's not as significant impact. So I think that's how I'm seeing things with our client base and our self-funded retirees. But then if I translate that into the clients you see and potential investors, I think, well, has anything fundamentally changed in terms of, I don't want to be buying commercial property because my returns are significantly muted now because of the introduction of this tax? I don't think it's that material.
I think certainly the 2 to 6 mil price point for us is the one where I'd say 80-85% of people buying in that market for investment purposes are typically using some sort of super vehicle, and they're probably the ones who are a little bit apprehensive, going, well, I probably don't want to get off the starting blocks just yet, right? They're happy to leave their other stuff where it is, if they do have something, or if they're looking at buying something, that they're sort of a little bit hesitant. What you said was really interesting, actually, about the capital gains tax and the Div 296. So I guess what I've found a lot of is I've been doing a lot of these letters for a lot of people for assets that are held in their super. When they're getting to pension phase, they're able to push that asset into pension phase, and I suppose from the government perspective, they miss out on the capital gains element of that after they push it into pension phase. Is that right? Yeah. So it's almost like you say, it's a cash flow thing. It's not actually just cash flow impost for the investor. It's actually it's the government looking at trying to get cash flow out of super because they're actually missing that uplift in value.
Fully agree, and that's what I think is the big change is that the tax office taking tax as they go,
Yes.
not waiting and deferring it and crystallising it in pension phase and you know, losing the tax net. So it is a timing issue, but like I said, that doesn't fundamentally, as far as a vehicle for investment, I don't think it fundamentally changes how you would make an investment decision. And it's if we talk about commercial property in your space, like it's not as if it's levied on commercial property and not on shares or not on other asset classes. It's consistent across the board. So if a client's thinking about, you know, putting money into the stock market versus buying commercial property, from a Div 296 perspective, you should be working, as far as your overall return, you should be, it applies exactly the same.
Yeah, sure. Yeah, I think, as I said, it's just a really interesting space, right? And it's, you know, in commercial real estate, you know, we're like there's an impact on us. You know, in the financial planning space, there's an impact on you. So, you know, our phones ring more, your phones ring more, and it's not work that sort of puts dollars in the bank, so to speak. It's us trying to actually unpack and understand the changing environment that we're both faced with, and trying to provide the best advice to our clients. So look, I suppose, you know, we're sort of aligned. Look, I think, again, commercial real estate is undoubtedly, you know, the best place to park your money. You're probably going to have a bit more of a balanced view, and that's probably a fair thing.
But in context of Div 296, I will say that one asset class within super, that like volatile assets in self-managed super funds are where I suppose I've conceptually got an issue, and I think there's lots of risk in a self-managed super fund where you can have, you know, periodic large gains without cash to fund the tax, and that's not, you know, that's a kind of profile of an investment, say, you know, Bitcoin, cryptocurrency, highly volatile shares. I'm not like with commercial property, you've got a stable asset that's growing, you know, kind of, you like to think strong but consistently over time, so you're not going to be facing those kind of risks and issues. So I'm seeing clients move those more volatile assets outside of super, but not property assets. Interesting.
Anything else, mate, that we haven't sort of run through today, you know, around the Div 296 stuff?
No, like I think that.
Do you think it'll happen?
Well, yes. I think it is going to happen. It's just more what form it takes and the details of that, how it's levied and all that kind of stuff. So I think it's here, and we should be planning for it and considering it and thinking about it, and that's what we're doing with our clients. The other thing I would say is, after looking through it in depth, like detail and analysis across several funds of varying value, then I know from an advisory standpoint with our clients, we haven't had clients move assets outside their fund. That may be a function of the kind of clients we've got and the kind of assets they hold in their funds, and the fact that, you know, they're not volatile, and when we look through their structures, there's no tax savings to be achieved in other vehicles, but also we look at the tax cost of moving assets like stamp duty, capital gains tax, crystallising moving assets. So when you look through making any of these knee-jerk reactions, you know, our conclusion has been status quo. So we actually have done a lot of work to arrive at the conclusion that it's not that bad. We have to live with it. We have to factor it into our decisions. But I wouldn't be making any knee-jerk reactions, and I'd be waiting for the detail to come out.
Yeah, fair enough. All right, excellent, mate. Thanks very much for your time. So, Pat McStay, New Leaf Advisory, Brad Lord, RBC, Sutherland, Shire. Thanks for that, mate. Appreciate it.
Cheers.
Ta.